Focus, ideate, innovate, enable.
Hello and welcome to the Derivatives Show. Commodity futures is our topic of discussion for today. How are derivatives in commodities different from equities, and how to trade bullion is what we'll find out from Kishore Narne of Motilal Oswal. Kishore, good to have you with us. Let's start with the basics. First, what all are the different commodities in which Indian investors can play the derivatives segment?
See, the entire market can be broadly divided into major segments. One is the agricultural commodities and the non-agricultural commodities, and within non-agricultural commodities we have commodities like precious metals, you have industrial metals, and you have energy complex. Typically these are the broad-based commodities. And in agricultural complex you have commodities like grains, this is typically the staples, and softs like sugar and cotton, and other exotic commodities like guar and spices, a lot of things, everything which you can imagine as a tangible commodity you can trade. So as far as Indian commodity markets definition goes, anything which is in raw in form and can be delivered can only be traded. So unlike the Western counterparts where the weather futures, rain futures, other derivatives are traded which are non-deliverable,
right,
Indian markets doesn't allow them. So it is purely deliverable commodity market.
Across the basket, which are the five most traded commodities?
I think top two are the silver is the number one, then gold, then comes the copper, then crude oil, and natural gas. This is the top 5 commodities basket. So I think in Indian market it's completely skewed towards these 5 commodities. I think 75-80% of the Indian volumes happen in this.
You know, when you're looking for a commodities exchange, what should you be looking out for? Because you need a contract which is liquid, where you can easily make a position. You will find a buyer or a seller at the opposite end as well. Where do you find a comprehensive list, and how should you locate the place where you find liquidity for yourself?
Nearly around 80 to 90 commodities are listed on Indian markets, and if I'm not being very optimistic about that, probably you can find in almost all the commodities. If you are a retail investors, the liquidity is not a big problem. The issue is that in the last bottom 10 of the commodities, maybe spices and some of the commodities like smaller commodities like rubber and cardamom kind of things, most of the other commodities, 80% of the commodities, out of that 80 commodities, maybe 60-70 commodities, if you are an investor who is investing, let's say 2 to 5 lakh rupees kind of investment, so you will find enough liquidity and you don't find any problem in entering or exiting these commodities.
Now we come to the key differences between, you know, equities and commodities. Clearly they are not traded the same. There are differences in terms of expiry, deliverables, etc. Take us through those.
I think the primary difference between these two markets itself is that the investors are typically different. The mindset is completely different. You find a lot of volumes in commodity markets coming from upcountry rather than metro cities. Metro cities typically contribute lesser volumes, and upcountry, a lot of people feel comfortable trading commodities than the equities. Actually they feel that probably I understand China much better than I understand Infosys. For him, he looks at China, he goes to the mandi, he trades this every day and day out, so he feels much more connected. So that's where the volumes in agriculture markets, or even for that matter, because he has that habit of trading commodities, he also trades in gold and silver, irrespective whether he does know something about them or not. But predominantly the difference is that you have very high amount of leverage in commodity markets, number one. Number two, most of the commodities have different expiry cycles and different months of trading. Let's say agricultural commodities are traded I think 9 months to 10 months out of 12 months. In between there are 2 months which don't have contracts. Typically these are the harvest months. So when you are trading in agriculture commodities, you should be aware of when the crop is sown, when the crop is harvested. So it's like a fundamentals in equities. Same thing for if you are trading gold. Gold is nothing but a Xerox copy of the COMEX contract. So typically the expiries work on bi-monthly basis. Gold and silver are bi-monthly. You have 6 contracts in a year.
Right.
There's no contract for every month. And for copper it's a 12-month contract. So every month you have a contract. So I think so there are various commodities, even for industrial metals like nickel, zinc, lead, every month you have the contracts. So and the expiry is also different. Like few commodities like mentha oil, you have 31st of the month every month, and for gold and silver it is the last working day of the previous month is typically expiry, and most of the agricultural commodities are 20th of the month. And also there are concepts like staggered delivery. So I think in agricultural commodities, the last 15 days before the expiry, any day you can get a delivery. So as a buyer, you should be aware of that you at any point of time you might get a delivery and you will be asked to pay the 100% amount of commodity, and you will get a commodity in your demat account. So if you are not interested, you should be aware of this, when I should roll over and get out of this position and go to the next month. I should not be getting delivery. So I think once the investor should take care of this basic things before turning an investor in commodity market.
Kishore, that's exactly the question. You see, the thing is, for equities, the expiry is always the last Thursday of the month. Here you have seasonality, you have harvest season when you have no contracts. For a financial investor, what are the broad things that he needs to take care of, and how easy is this market to manage if your sole agenda is to bet on a commodity, make a profit and exit?
See, one common thing which we hear from investors is it's a common problem. We try to tackle it because a lot of investors come and say that I want to make money in gold, or I want to make money in crude oil. I think it is something like saying that I want to make money in Infosys, or I want to make money in Reliance. I think the investor should be looking at a whole market as a perspective. He comes to an equity market, he tries to say that, okay, I will invest X amount of money into consumer durables, I will invest X amount of money into telecom. There is a sector wise differentiation, or he will say that, okay, I will invest in index 30 stocks, something like a portfolio or something like that. But in commodities, unfortunately, people say that I want to make money out of natural gas itself, which becomes extremely difficult. If you are trading the same commodity every day or on a daily basis, your success rate of making money will go down. So my suggestion is that concentrate or believe in the opportunity, not in the commodity. So divide your money. Probably you can say that, okay, at this point of time, China is looking much better than say natural gas. So probably you have nothing to do with China, neither natural gas. You are a financial investor, you are looking for a profit. So where you have a more fundamentals in nature, that you can see that China price is going up because so and so reason is there. So you have an open interest built up, or you have various derivative data which is available. So the opportunity is more important than the commodity.
Okay.
And spreading your money into various commodities is extremely essential here, and keeping your leverage in control, because commodity markets tend to provide you that leverage, extra leverage.
Okay.
So a lot of times it acts as a double-edged sword, and you get against you as well. And a lot of times people look at the positive side of the leverage and they forget about the negative side, and they end up in making a huge loss and complain that commodity markets are bad.
Kishore, we're going to take a short break here. When we come back, how do you make leverage in commodity markets work to your advantage? What are the other levies, the taxes that you are liable to if you want to trade commodities? Stay with us on the Derivatives Show to find out more. Welcome back. You're with the Derivatives Show, and with us is Kishore Narne of Motilal Oswal. We were discussing leverage, which is a key factor in investing in commodities derivatives. Kishore, explain to us, if there is an investor who allocates 1 lakh rupees for an investment in commodities, should he go out and purchase commodities worth 1 lakh rupees, or does there have to be, say, a 25,000 rupee investment? How does he manage it?
I think the first thing which one should remember is, with 1 lakh rupees margin, there is a margin. I'm specifically mentioning the word margin. It's not the capital. Margin, you can buy, let's say if you are buying gold at 5% margin at the exchange, you have 20 times leverage. So 1 lakh rupees worth of investment give you an exposure of 20 lakh rupees. So one should be very much aware that your risk or your profitability is on 20 lakh rupees, not on 1 lakh rupees. If the 20 lakh rupees worth of commodity moves by 1%, let's say it's almost 20,000 rupees.
Right.
So your 1 lakh rupees will be down or up by 20%. So it's always multiple times. So the same thing happens in equity derivatives also, but equity derivatives have higher margins. So let's say 10% is the Nifty futures, and from there it goes up to 25, 30, 40% also in some stocks. But here it is at 5%, in some cases it goes up to 10, 12%. So you always have higher leverage. So what happens is, when you are investing, the investor has to look at the exposure, not about the investment. So he should be taking, let's say that I want to, let's say on 1 lakh rupees, I am willing to lose 10% of the money. So the first thing an investor has to decide is how much I am willing to lose. You have to start with that. Okay, I am comfortable in losing 20,000 rupees, that is 20% of my capital, that is my risk appetite. So I can look for a return somewhere around 25 to 40% or 30%, whatever it is. So there is an objective of profitability and there is a risk parameter. So do I want to lose this entire 20,000 in one single trade, or I want to distribute into 10 different trades? So if I have to distribute in 10 different trades, so per trade I have to lose 2,000 rupees. So I need to buy a commodity which should be moving 2,000 rupees or less in a day. So my risk is under 2,000 rupees. My stop loss should be somewhere, and put this 1 lakh rupees into that. So in a day, if the trade goes against me, I will lose 2,000 rupees. I still have 98,000 rupees to trade the other day. So a lot of people, what they do is they calculate that, okay, I want to have a 10% stop loss, but the 10% on 20 lakh rupees, which goes to I think 200% of their actual investment.
Correct.
So it's significant. So they end up with losing money more than what actually they invested. So it's more or less mismanagement of leveraging, mismanagement of capital allocation, and mismanagement of risk management policy. I think this is they are the three things which goes wrong in commodities.
Now, in which case, the one thing that we've established is that the investor has to ask not how much do I want to make, but how much am I willing to lose? How much can I tolerate? How much pain can I tolerate? If you had that 1 lakh rupees, how would you advise the investor to go about building his position over that span of the year? Because two things that you've mentioned, one is a diversified portfolio. Here the portfolio seems to be far more complex, because there are commodities with different expiries. There are some which have a 2-month contract, not a single month contract. Some of them don't trade when there is harvest season. How would you advise them?
Let's say that I would like to lose 20% of the capital. So my risk tolerance is 20,000 rupees. So in a trade I should be putting not more than 2,000 rupees as a stop loss. So, and also again I need to distribute this among various commodities. If I am trading gold and silver, I buy 1 lot of gold and 1 lot of silver. Actually I am doubling my positions. Both these commodities move in the same direction. Right, so these are both are fundamentally same. They are both precious metals. They react in the same way. So I am doubling my risk. So I need to offset the risk through something else. So I will trade 1 lot of gold, but I will trade something else like 1 lot of copper, which is an industrial metals. So the logic is that if the economy is prospering, industrial metals too should go up, and the safe havens like gold and silver should come down. So there is an offsetting risk advantage. So you have to distribute this thing in that way. And secondly, you can distribute some more into agricultural commodities. Agricultural commodities are much more safer than most of the metals actually. Because you have an intrinsic value. A chana, a lot of chana, a truckload of chana, let's say a truckload of chana cannot go down by 20-30% in a day, which is more or less possible in stocks also. Most of the stocks you can see that 10% movement in a day, but none of the commodities move 10% even once in let's say 4 or 5 years. That's a one major advantage of commodities. So you need to diversify this number one. Number two, yes, there are various maturities, but your portfolio has to be reviewed almost every week. It is a weekly basis review of portfolio, and it needs to be tracked on daily basis. If you don't have that much time that you can spare a half an hour to reposition yourself in the markets, you should not be really into commodity markets. And number two, you should have enough buffer capital where you can pump in money for the mark to market purposes. So you should never be 100% invested. You should, my suggestion is you should never be more than 50% exposed. So let's say you want a capital of 1 lakh, you should never be utilizing more than 50,000 rupees.
Now let's come to the issue of taxation. What are the different kind of levies? Do they vary across different commodities? And if you're investing say 1 lakh of rupees, what would be the total amount of levy that you would have to keep in your kitty?
I think, see, if the levies are more or less same to all the commodities except the CTT, the commodity transaction tax is not applicable on agricultural commodities, or you can say raw commodities, not the manufactured ones. The manufactured ones still attract, like soybean oil, which is a manufactured commodity, or sugar, which is a manufactured commodity, normally attract this. Otherwise, metals have the CTT, the commodity transaction tax, which is 1,000 rupees on a crore, that is almost 1 paisa on 100 rupees. So this is the only difference in the commodity wise. Otherwise, I think more or less the levies are your brokerage, service tax on brokerage, CTT and service tax on CTT, the stamp duty, and the exchange turnover charges, and the service tax on the exchange turnover charges. So I think if you combine all of them, and let's say you are putting 100 rupees, 100 rupees normally give you, let's say, 20 times of leverage. So your overall position on 100 rupees can go up to 2000 rupees exposure. So on 2000 rupees exposure, your more or less cost will come to around 75 paisa to 1 rupee. Let's say if you multiply that to a lakh rupees, probably you can have 700 rupees to 1000 rupees is your cost on a 1 lakh rupee investment.
Right, thanks for that. We're going to take a quick break on the Derivatives Show. Stay with us for more on the other side. Welcome back. You're with the Derivatives Show. Now, gold is a favorite with Indian investors, even as far as derivatives go. But Kishore, tell us, can one take a pure position in gold and hold on to it with the expectation of profit, or is there another way to go about it?
Certainly, we have that passion towards gold, and it's been paying us loyally also. Our loyalty was been rewarding over the last 10 years or so, I think. So after more than a decade rally, it seems unlikely that we'll have the similar kind of returns in the next few years. So I would suggest not to completely exit gold, but slightly reduce your positions and bank on something else which can provide you, if this entire 5-year recessionary scenario turns around and the global economy starts to perform. So typically you need to have this diversification. Once again, I've been insisting on the diversification.
We spoke about if you have a lakh of rupees to invest in commodities, you advise that only be invested to the extent of 25,000 rupees.
Right.
Now, given that 25,000 rupees, how would you break it with a certain allocation to bullion and the other commodities?
See, you take crude oil, let's say that one lot of crude oil costs you around 5 lakh rupees. It's the exposure value, 5 to 6 lakh rupees. So on a crude of let's say that on 6 lakh rupees, your margin comes to around 30,000 rupees, and your risk in crude oil is typically in a day it moves somewhere around 40 to 50 rupees. So it's a 5,000 rupees plus or minus at the end of the day. And copper is somewhere close to 4 lakh rupees is the lot, per lot. So and again comes down to around 20,000 rupees your investment. And gold, if you are trading 100 grams of gold, which comes to around 3 lakh rupees is the exposure. So 3 plus 6 plus 4, so roughly around 13 lakh rupees is your exposure, and you have 1 lakh rupees. That means you are taking 13 times of exposure, where you have 20 times of exposure available on the exchange. So you are under leveraging yourself, and at the same time you are banking on 3 different commodities. Unlike the equities, commodities completely behave in a different way. All the gold, silver and crude might not go up or might not go down, and depends on how the fundamentals of crude and how, because crude is
exactly that. You see, you built a portfolio of gold, you've kept silver out. Now, first question is, why would you not buy both gold and silver?
Because these two commodities are the same, like buying Airtel and Tata Communication, like you're buying 2 telecom companies. So it's the same thing that you're buying the 2 stocks out of one sector, and both will behave in the same way. So which will either double your risk or reward at the same time. So it is nothing, it doesn't add any value to the portfolio.
Right.
If you have to be bullish on precious metals, you can take a call which will move better. Let's say that if silver is too much beaten down, probably silver might be a better bet, so ignore gold and then move into some other commodities which will be offsetting this risk.
Exactly. Now explain that to us. So you're saying choose either gold or silver. Then you said take a call on copper and crude oil. How do these work against each other to keep your profits or your capital intact?
See, copper typically is driven by Chinese economy, typically how the manufacturing sector overall globally is looking at, if the global PMI numbers typically work in favor or against the copper. So if you are looking at that Chinese PMI numbers are going to come, or the economy is going to revive due to an activity by Bernanke or some of the Fed activities, or some kind of a fundamental outlook, crude and the copper gives you better returns. But again, crude is decided by a lot of factors which could range from Middle Eastern crisis to Syria to Iran and global fundamentals like macroeconomic fundamentals. So you're taking a bet on some of the Middle Eastern crisis and a global economy recovering through crude, and you're taking a bet on macroeconomic factors. You can be short or long. I'm saying that if you're looking at a negative PMI numbers, you can be short on copper. You're betting more on economy deteriorating further, and you're taking a copper short position. And at the same time, you can take a gold positive position, where if the global economy deteriorates, the demand for safe haven increases and the gold prices should move up. So somewhere you need to invest in time. You need to understand the commodities. A lot of the most common mistake people do is that punting on commodities without knowing them.
Next question that arises in my mind is, how long a tenure should you keep? How many, if you have a future which is for say about a 2-month period, or if you need to roll over, what is the horizon you need to keep in mind? Because as of now, when we see gold prices have been subdued, the equity markets are on some bit of a rise, but as far as commodities are concerned, copper is down because overall there is an economic slowdown, right, and there is a moderating in some economies. Gold prices are subdued. What kind of expectation can you have from this portfolio then?
When these two commodities are struggling, you can observe that crude has paid us handsome returns over the last month or so. It's up by more than 10%, and gold is not down 10%, and neither copper is down 10%. They have been flattish to slightly moderately bearish. So overall, this portfolio always performs better, and this is a very good highly liquid commodities. And the first thing which one should look at is that the size of the portfolio has to be decent enough. You should have a minimum of 2 to 3 lakh rupees as an investment if you need to make decent returns in commodity markets. People tend to come with a very small amounts and over leverage themselves, where they don't have any buffer money. Those people, it makes really difficult and no chance to make money. So you need to have a decent size of 3 to 5 lakh rupees investment size. Within that, as I said, that this portfolio of these 3 commodities will warrant you a margin of roughly around 1 lakh rupees. So if you have 3 lakh rupees, you are invested 1 lakh rupees, still you have 2 lakh rupee buffer. When you have this additional buffer capital, when you get an opportunity, so you need to be opportunistic at times, because you are looking at a fundamental change in X commodity. Let's say there is a drought or there is a flooding in particular area, and that crop is going to be washed away. You have a opportunity at your hands. Go and strike it, go and buy that crop, so you can make money. So if you are fully invested and you get an opportunity, you are always stuck. You don't have anything, and also you need to pay up the mark to markets next day. Correct. So, and my perspective is, typically you look at a weekly perspective in commodities. Most of the people tend to invest for 1 hour, 2 hours intraday kind of a thing, but I would suggest that a weekly perspective in commodities would be much better rewarding than trading intraday.
Thank you very much, Kishore, for joining us on today's episode. That was Kishore Darne telling us how we can make our beginnings in the commodities derivatives market as a financial investor. Do remember to diversify. You need to review your portfolio every week. Also, as he said, you must under leverage yourself, not invest all your funds in a particular commodity and never invest it totally across your portfolio. Thanks very much for being with us on the show today.